Is Singapore about to stop you buying crypto? And could it be for your own good? I'm Joel Flynn. Welcome to the Daily Forkast, July the 5th, 2022. It is yet another day when crypto contagion is spreading. Vauld and CoinLoan are the latest firms to stop customer withdrawals. Celsius, meanwhile, is cutting jobs to try and stay afloat, and Singapore is changing the rules. What is the latest on what is happening in the crypto winter? This is the Daily Forkast from Asia to the world.
Join thousands of NFT traders who already start their day on CryptoSlam.
So Singapore wants to toughen rules up on crypto firms. The astonishing problems at Three Arrows Capital have got authorities there understandably worried. So they are looking to change the rules on leverage and limits on participation for individual retail investors. The Monetary Authority of Singapore, the MAS, has said it is especially concerned about the big falls that it's been seeing in crypto prices. It has also said it wants more international cooperation with other regulators. That's something that's apparently already being discussed at the international level. The potential rule changes come, of course, as another crypto exchange has suspended withdrawals. This time, it is a company called Vauld. Vauld is backed by Coinbase, among others. It said customers have pulled some $200 million from it since the middle of last month. In a statement, the Singapore-based firm said it is talking to financial and legal advisors and it's looking at restructuring. The company is also, though, trying to stop legal action while it sorts its problems out and while it deals with this, quote, restructuring exercise. There's bad news too if you've got crypto with CoinLoan. It is slashing daily withdrawal limits from $500,000 to just $5,000. The Estonia-based lending platform is worried about a surge of money being taken out. It is trying to ease worries about the new limits, though, saying they're only supposed to be temporary. The takeaway of all this is very clearly that investors have a lot of reasons to worry about who is handling their crypto. CoinLoan and Vauld, of course, join Celsius Network, Voyager Digital, and a litany of other firms who are trying to cut customer access to their funds. Let's talk more about Celsius. It is trying to work on avoiding a complete collapse. According to DeFi Explorer, Celsius has paid back $140 million of debt over just the last few days. That means the liquidation price for its wrapped Bitcoin loans is now below $5,000. It still, though, owes $82 million on the Maker protocol, but it's cut 20% of its staff too, getting rid of 150 people, according to an Israeli media report. There's never been a more important time to stay across what's happening in crypto. If you want to stay informed, go to our website, Forkast.News. We have got the latest on everything that's going on, as well as the vital analysis that you need to find out what it means for you. Very clearly, crypto contagion is spreading. Vauld and CoinLoans are the latest to say their customers are being hit. At the heart of this crypto winter, Three Arrows Capital. But who is next, and what could it mean for your crypto investments? Forkast's Lachlan Keller has this report.
The downfall of one of the world's largest crypto hedge funds has sent a shiver through the industry, with one expert telling Forkast he expects a snowball effect down to bigger institutions who may have lost faith in the whole situation.
Not everything is being tabulated. Not everything is being collated properly as of now. So I still think that there will be a bigger disaster that's going to come.
Meanwhile, Igneous Terranus of Bybit says we've seen similar events happen before in the financial world.
It's almost a repeat or like a rhyming what happened with the subprime mortgage crisis, where they just have to go further and deeper into more risky area because there is so much appetite. And they are also susceptible to bank run when when the credibility or like the confidence is shaken. You suddenly have all your depositors asking for their deposits back at the same time.
However, Terranus says trust is a key issue, and that's why decentralized lenders like Aave, Compound, and Curve haven't suffered in the same way.
They actually worked better because to them, an ERC20 address is just an ERC20 address. They don't rely on trust. If you don't have enough collateral, your position gets liquidated.
Veteran financial analyst Andrew Sullivan agrees. saying that disasters have happened after people with good track records were given access to large amounts of credit in the past, and how the industry reacts this time around is vital.
It happens to everybody. The fact that it's happening to crypto now, I don't think should come as a surprise to people. The really important thing is what the crypto industry does now that it's happened, and we see that we are as fallible as the rest of the financial sector is to risks and disasters.
Terraner says the financial industry is built on confidence, and even if the money promised as bailouts from big names like Goldman Sachs doesn't materialize, the offers will help.
What it does is it buys more time for those stressed institutions to kind of like quell the worries of their customers, and then to give them more time to kind of find a way to get back on their feet.
Leon says without a change in the fundamental way these lenders work, there will always be problems. However, he remains optimistic long term.
As long as there's a centralized authority in such financial protocols, they are bound to have some of these loopholes or some gray areas. So I still hope to see that being cleared up as well, and that would change a lot, and that would help us maybe go into a super cycle again in the next 2 to 4 years' time.
Of course, we'll be keeping a close watch. I'm Lachlan Keller, Forkast.
The key issue in crypto markets, of course, is leverage, how much some firms have been borrowing to invest. It's hurting customers in Asia and beyond, but new leverage products are still potentially hitting the market. Let's talk about why with Benjamin Stanley of Matrix Port. Benjamin, great to have you with us as always.
Thanks for having me back.
Benjamin, I want to ask you specifically about one product, potentially from Citi. It's talking about mortgages collateralized by crypto. What is your take on that? What is the potential risk involved in that?
Yeah, it's an interesting product. Although in essence, I would say crypto-backed mortgages is just another way of crypto-collateralized lending. In a traditional mortgage where the borrower uses their credit score and their paychecks to qualify, whereas in a crypto-backed mortgage, they only use crypto as additional security. In both scenarios, the property remains the ultimate security for that mortgage. Now, many people in crypto, it's one option to be able to buy physical property. And these type of products actually came popular during the last bear market. In 1819, large whales were mostly miners. They didn't want to sell at depressed prices, and so they opted to borrow against their crypto assets in order to keep the lights on. So basically, it's just an extra layer that provides security for whoever's the mortgage lender. And so therefore what they would do is they will liquidate the crypto first before taking control over the property physically. And so that creates some kind of selling pressure as prices for crypto fall.
Yeah, Citi's also been looking into mortgages for the metaverse, for virtual real estate. What do you make of that talk in particular?
We're talking about land in the metaverse. I think it's important to remind everybody that so-called virtual real estate is nothing else but an NFT as well, because basically everything in the open metaverse is an NFT. And so I understand how virtual land sounds very similar to the real world real estate, but it actually, I believe the terminology mortgage might be a bit misleading here. It can create a false sense of security that virtual land has some superior qualities over other real generating NFTs, which I'm not sure it actually has. Having said that though, I think lending versus true yield generating assets makes a lot of sense. And that's what's happening in TradFi all the time. I think it's not surprising that banks are entering crypto-backed asset lending, and I would also expect that the range of crypto assets that are considered by banks as qualifying collateral would increase over time.
As I said a moment ago, leverage perhaps the biggest problem in crypto right now. This is why some are stopping withdrawals, because they've borrowed too much. Are you surprised by the extent that some of these firms have leveraged themselves, and more importantly, what happens next?
The issues with lenders is arguably one of the main reasons why markets are much lower now than they were a few weeks back. And as you rightly said, excessive leverage within crypto institutions is what brought us there, and we're witnessing the painful unwind of that now. So I think many lenders, as you can see, have halted withdrawals. High-profile institutions, as you mentioned, have declared de facto bankruptcy. This has frozen the interbank market and caused borrow lending rates to spike, which is overall not good for us. And I do believe that we're not done. We're not out of the woods yet. We'll most likely see more players come out next couple of weeks announcing that they're under liquidity pressure, and they will probably have to downsize or close operations. At the same time, though, the players that have sound risk management and survive this liquidity crunch will most likely come out stronger after the stress test. And these players are the ones that will most likely consolidate the market and hopefully instill overall better risk management practices to their industry.
Yeah, and Sam Bankman-Fried certainly seems to be at the top of that, doesn't he? Listen, thanks so much for that, as always, Benjamin.
Thank you very much.
And finally, NFT sales might be at a 12-month low, but one sporting icon reckons it's actually the right time to slip into the ring. Filipino boxing legend Manny Pacquiao is launching an NFT collection. It is dog-themed. It's named in memory of his Jack Russell Terrier, Pac-Man. The collection will be minted on the Cardano blockchain on July the 15th. It consists of almost 10,000 algorithmically generated NFTs. Those will have visual and skill-based attributes like strength and stamina. Holders can also participate in blockchain game Pac-Man Boxing League to earn rewards. Will it be a knockout? Watch this space. And that's your daily forecast. If you want to stay informed, follow us on Twitter at Forkast_News. I'm Joel Flynn. I'll see you next time.